look at currency pairs. What constitutes a major versus a minor or a cross pair, and what are the relative advantages or potential disadvantages between those different kinds of currency pairs. So let's put a little bit of a sense of scale so we understand the difference here. The Bank for International Settlements, they do a survey of central banks about every 3 years. And in 2013, they reported that there was an average volume in the Forex of about $5.3 trillion per day. Now, about 88% of that actually was with currency pairs that had the dollar on one side or the other. So it's obviously going to be one of the key currencies that will identify a major pair, although some of the more minor pairs or exotic pairs will also be crossed with the dollar from time to time. But generally speaking, a major pair is something that is crossed with the dollar and that represents a reserve currency or a very popular currency where there's a lot of liquidity, a lot of trading being done. So as an example, actually, the euro to the US dollar, just that pair itself is about 24% of all trading volume every day, at least according to the Bank for International Settlements in 2013. But other currency pairs, as you might imagine, are similar. So let's say the Great British Pound versus the US dollar, let's say the dollar to the yen here, this would also be considered a major pair. And the advantage that we have here with the major pairs is that they are highly liquid, and this does two things. Number one is that it's a little easier to get or faster to get execution, especially during times when the market is a little volatile. Now, it also means that the difference between the bid and the ask is also a lot more narrow. So the difference between the bid and the ask is one of those trading costs that we can't get away from, but the traders can control. So they can decide how often they're trading, for example. Well, if the bid and the ask are narrow, then that's going to save us on our costs overall. And since that's one of the few things that traders can actually control, all else being equal, it may make a case for why a major pair fits a trading strategy versus one that it doesn't fall into the majors category. Now, there is a little bit of overlap here where some currency pairs that are considered majors fall into between the majors, and some of them will even fall into another category that we call minors or crosses. And these are the commodity currencies. So a commodity currency is a currency that is going to be very sensitive to changing values in the commodity market. So one that you can imagine right away would make sense is the Australian dollar to the US dollar. About 8% actually of all Forex trading, according to the Bank for International Settlements, is involving the Australian dollar. So it's very actively traded. Or the Canadian dollar, so currency pairs with the Canadian dollar in it, it's about 4%, a little over 4% of total trading out there. So commodity currencies, these would certainly fall into the category of a major because they're nice and liquid. But the other advantage that we get here is that we have indirect exposure to the commodity market. So in fact, let's look at an example of how this actually works with commodity currencies. During the 2008 market crash, the Chinese government stepped in with a very powerful easing program or stimulus program there domestically. One of the side effects of that was to increase demand for basic commodities quite a bit. So as you can see here on this chart of the Aussie to the dollar, from 2008 through 2011 approximately, the Australian dollar, which of course should, all else being equal, should actually benefit quite a bit from that increased demand for commodity prices, especially relative to the dollar, where the US was in recession at the time. Well, from 2008 through 2011, as the US economy began to recover a little bit, the Australian dollar to the US dollar rose in value by 85%. So this is a dramatic example, but just for instance of exactly how commodity currencies do provide some indirect but effective exposure to commodity prices. Now, speaking of commodity currencies, there's another one that we think about as well, where I'm going to put them all in the category of the crosses. Now, a crossed currency is one in which we may not have the dollar on one side or the other. So let's say, for example, now they may be actively traded, and in some cases, they may include currencies that would both be considered majors when they're crossed with the dollar. So for example, take the pound to the yen. So that would involve two currencies that kind of fall into the major category, but when they're crossed with each other like this versus the dollar, it likely has less liquidity. Now, in this category, we might also throw currencies that are more exotic. And in fact, they're oftentimes referred to as exotics. So let's take, for example, the dollar to the Mexican peso. Now, there are advantages here, but they generally, because we have less liquidity, they will be a little bit more expensive to trade. The difference between the bid and the ask does tend to be wider, and illiquidity or problems getting an order filled during a market volatility could be more challenging. But one of the advantages we have here, let's say, for example, with the dollar to the Mexican peso, is that a trader would be able to have indirect exposure not only to the commodity market, oil, for example. The Mexican peso is very sensitive to the price of oil, but also to emerging markets. So as emerging market economies are doing better or worse, well, that's certainly going to affect the value of the Mexican peso as well. So depending on your trading strategy, you have choices between what kind of currency pair am I really looking for? One of the majors, a commodity currency, maybe a commodity currency that falls into the category of a cross or an exotic, or a currency that is not taking advantage of commodity movement, but is just taking advantage of the relative strength between two currencies that does not involve the dollar. So for example, here between the pound and the yen. Now, depending on your overall trading strategy, one may make a lot more sense than the other, but we always have to remember that there's going to be a bit of a trade-off, that the further we go down along this spectrum, we're trading off some liquidity and potentially higher costs in favor of either a more focused exposure to what we're exactly trading or the economic impacts that we're trying to take advantage of.